Nick Cregan from Fairlight Asset Management. Welcome to the Growth Symposium.
Drew, great to see you again.
What do investors most need to understand about this global small and mid-cap market?
Well, I think the thing that's lost on a lot of Australian investors is just the size of the asset class. It's some 40 times larger than the Australian equivalent. I think the number is $12 trillion, I think the market cap is. And it's just a huge opportunity set that most Australian investors are missing out on.
And what does the universe look like? We spoke to someone recently that said Cochlear almost fell into global mid-caps.
That's actually a really good point. So most investors sort of think global small and mid cap, surely they're more risky than my large cap portfolio. The thing to keep in mind, if you're happy with the risk of the ASX 200, so the biggest businesses in Australia, you'll be more than comfortable investing in the mid cap market globally, and especially in the US. So a mid cap business in the US goes up to about $35 billion in market cap. So the Fairlight portfolio, the weighted average market cap has been between 12 and 15 billion dollars through time. That would put it firmly in the ASX 20 in terms of market cap exposure.
We've heard a lot about the outperformance or the risk-adjusted returns from small and mid-cap companies versus global large-cap companies. What are some of the key drivers between that valuation difference?
There's a valuation difference, and you're right, there is a volatility difference there as well. There's actually a really attractive blending opportunity. So if you look at the data over the last 20 years or so, you can actually get a nice uplift to your alpha numbers, about approaching 40 basis points with no demonstrable increase in the sort of combined volatilities if you're blending 75 large caps, 25 small caps. The reason for that, or mid caps I should say, the reason for that is that whilst those two asset classes are highly correlated, they do walk to the beat of their own drum a little differently. So large caps will move a little bit more with geopolitical risk, what's happening in sort of the US-China relations, whereas small caps and mid caps tend to be buffeted around a little bit by sort of local news or the conditions in the local market. So whilst they're correlated, there is a diversification benefit that comes with that as well. But to your point, small caps and mid caps over long periods of time have outperformed large caps.
And what's the difference between, say, an Australian small cap and global SMID cap?
Yeah.
That, as we kind of referred to before.
Yeah. So firstly, market cap. So mid caps up to about $35 billion in value. Small caps in Australia, I think they cut the number off at, I think it's $2.5–3 billion, I think is the number. I'll have to refresh myself on that data. But one of the really key important differentiators in global versus Australia is Australia's actually quite use a term here, but over-broked market in so far as most small caps have some sort of brokerage coverage, so research on the businesses. What tends to happen is the higher quality small cap businesses in Australia get bid up to pretty ridiculous multiples at times. You get very similar businesses in the global market which have less broker coverage and often trading at quite a steep discount to what you can get here in Australia.
And how important is quality, and how do you assess quality within global SMIDs?
Quality, as you go down the market cap spectrum, in our view, it becomes more and more important. And the reason for that is if you are a large cap investor, you're almost by default quality investor. So less than sort of 5% of the US large cap market would be what you define as junk securities, those businesses that don't make a profit. That's kind of intuitive when you think about it. Like, it's quite hard to become a large cap company unless you compound your way there. So you're Johnson & Johnson or Coca-Cola. Surely there's every once in a while you get a Tesla, which raises money all the way until becoming a mega cap, but it's the exception rather than the rule. If you look at the small and mid cap market though, especially in the small cap market, almost half the market you could be considered junk. So those businesses don't make profits. They're the highly speculative sort of shoot and hope sort of businesses that you're looking for a 10 bagger, but inevitably the odds are stacked against you. So to our mind, the best metric to be looking at in the small cap market is quality, and we define quality as the cash return on capital invested. So we add back all of the accumulated amortization, depreciation, and every write down that the management team has had to make because of a poor acquisition to the capital base, and we're looking for a 15% cash return from that business. So they're actually churning out cash year on year.
And how do you see advisors using SMIDs or global SMIDs within a portfolio?
Very similar to how they've done traditionally in the past, and without much pushback really on the Aussie small cap market. So most advisors would have large cap Aussie and large cap and small cap Aussie. Very similar in the overall allocation to global. So I think it's become accepted now that having some form of global equity exposure in your portfolio makes a lot of sense. The next derivative from that, I think what people are looking for is, what's outside of the top 20 US businesses that are maybe easy to talk to, but maybe aren't the opportunity set for the future. Those smaller businesses, sort of 30 billion and below, established companies, but in some cases have no broker coverage, are an exceptional opportunity within that.
Is 2023 a ripe hunting ground for Fairlight?
Sure is. So both the quality part of the market has been sold down disproportionately, we feel, and small caps have actually underperformed large caps since really since 2018, which is unheard of in its history. So it's actually trading at the cheapest valuation relative to large cap than we've seen in the last 30 years. So to our mind, if you're going to be considering small caps, that's a great place to start given the valuation. And if you want to reduce your risk, you can do so by taking a quality approach.
Nick Cregan, thank you.
Thank you so much.